Something massive is growing in the shadows of the global financial system, and most ordinary people have no idea it even exists. It doesn't trade on public exchanges. It doesn't face the same scrutiny as banks. It barely shows up in headlines. Yet today, private credit has become one of the biggest hidden risks in the global economy, and it is keeping economists, regulators, and central bankers awake at night. Private credit refers to loans made outside the traditional banking system. Instead of banks, these loans are issued by private equity firms, hedge funds, asset managers, and specialized credit funds. They lend directly to companies, often at high interest rates, with far fewer disclosure requirements and far less oversight than banks face. Over the last decade, this market has exploded. Why? Because after the 2008 financial crisis, banks were heavily regulated. Capital requirements went up. Lending standards tightened. Risky borrowers were pushed out of the traditional system. Private credit stepped in to fill the gap, quietly, aggressively, and profitably. At first, it looked like a win-win. Companies got access to funding. Investors got higher yields in a low-interest rate world. Banks reduced risk. But over time, something dangerous happened. Risk didn't disappear. It just moved into the shadows. Today, the private credit market is estimated to be worth trillions of dollars, and it is deeply intertwined with private equity, commercial real estate, leveraged buyouts, and highly indebted companies. Many of these borrowers would never qualify for traditional bank loans. Yet they are now carrying large amounts of floating rate debt at a time when interest rates have surged. This is where the fear begins. As rates rise, the cost of servicing private credit loans rises immediately. Unlike fixed-rate bank loans, much of private credit is floating rate. That means borrowers feel the pain instantly. Companies that were barely surviving when money was cheap are now being crushed by higher interest payments. Defaults are starting to rise, quietly. But because this market is largely private, the true scale of stress is hard to measure. There are no daily prices, no transparent balance sheets, no clear reporting standards. Losses can remain hidden for months or even years. This lack of visibility is exactly what terrifies economists. The second fear is concentration. A relatively small number of massive asset managers dominate the private credit space. If stress hits one corner of this market, it can spread quickly through interconnected funds, pension systems, insurance companies, and wealthy investors who believed they were diversified. What looks like safe yield can suddenly turn into correlated losses. Then there's the issue of liquidity. Private credit funds promise steady returns, but the underlying loans are extremely illiquid. If investors rush to pull money out during a downturn, funds may be forced to gate withdrawals or dump assets at fire sale prices. We've already seen early warnings of this behavior in parts of private real estate and private equity. Economists are also worried about the feedback loop. Many private credit borrowers are owned by private equity firms. When cash flow tightens, those firms may cut jobs, slash investment, or default altogether. That spills into the real economy. Layoffs, reduced spending, weaker growth, amplifying downturns. The most dangerous part is that central banks have very limited tools to deal with a private credit crisis. The Federal Reserve can support banks. It can buy treasuries. It can inject liquidity into public markets. But private credit sits largely outside its direct reach. If panic spreads there, the Fed may be forced to intervene in ways it never anticipated or watch the damage spill into the broader system. This is why private credit is so unsettling. It combines high leverage, low transparency, rising interest rates, and weak oversight, the exact ingredients that have fueled past financial crises. The difference is that this time the risk is not sitting neatly on bank balance sheets. It's scattered across private funds, pensions, insurers, and global investors who may not fully understand what they own. To be clear, this does not mean a collapse is guaranteed. But it does mean that the next financial shock may not come from where everyone is looking. It may not start in stocks or housing. It may start in a quiet, opaque corner of finance that grew too fast, too big, and too comfortable in the age of easy money. Private credit thrived when rates were near zero. Now rates are high. Liquidity is tightening, and the stress is building silently. That is why economists are losing sleep. Not because they know exactly when it will break, but because they know if it does, it will be messy, hard to contain, and very difficult to explain after the fact. If you found this breakdown helpful, make sure to like, subscribe, and share so you don't miss important financial stories like this that often stay hidden until it is too late. And with everything going on out there, both economically and literally, stay warm in this cold weather. Take care of yourselves, and I'll see you in the next update.